Welcome, everybody. It is 2 o'clock, 2:02 Eastern on Thursday, July 16th. We're here in Season 3, Episode 12 of Stride Live. Ask Me Anything, the financial Q&A with the CPA, and I'm here with a great one today. I'm Mr. Morgan Holmes, CPA, MBA, PFS. I don't know if I'm missing anything else, but Morgan, how you doing today?
Doing great. How are you?
I'm terrific. It's been busy lately. So, today's event was inspired by, first and foremost, a lot of email questions from viewers. I've been tracking actually all season a lot of questions that we've been receiving from during Stride Live. And what we've done today is put a compilation of those together. And then for the viewers today, if you have any questions, feel free. You can email them directly. You can put them in the Slack channel, or you can add them in the comments here today, and we'll add them as we go. Um, all questions today, we're going to do our best to answer with some best practice. And then after the episode, what we'll do is we'll make a little blog. We'll put an article together, and that way you guys have details of all the questions that we've answered. So, Morgan, are you ready?
Sure.
Sure. All right. So, one of the questions that I've been getting a lot as more and more MSPs have been expanding into multiple states, multiple jurisdictions, how they should be handling sales tax, especially on their service contracts, any hardware and SaaS. Just where should they be focusing their efforts to know, hey, do I need to be filing these jurisdictions? What is eligible for sales tax, and where do they start that conversation?
Yeah. So on the sales tax as well as income tax, for the most part, most states use, so many states use physical presence standards. So if you actually are in or have employees in that jurisdiction, you likely have a sales tax filing obligation. Many states have started moving from physical presence to market-based sourcing. So if you have customers in a jurisdiction where you're not actually in that jurisdiction, once you exceed certain thresholds, sales thresholds, then you become taxable in that jurisdiction as well, creating obviously an obligation to collect and remit sales tax. As everybody knows, every jurisdiction has its own rules. Some states tax software, some states don't. So I think a good place to start is I believe that Avalara has a free service where they will look at where you are doing business and help you decide where you should be filing. That's probably a good place to start.
Absolutely. When you talk about income filing, how does that differ from sales tax? Is that quarterly? Is that annually? Or does that kind of vary by state to state? Some of the questions are, hey, I'm in California, but I have clients in Colorado, Washington, Oregon, and Texas. Is it threshold? Is it timing based? This is new for them. So they've just expanded outside
Yeah.
of the state.
Yeah. So it depends on the state. So I think that question you just had there, the person was actually in California. California uses economic nexus standards. So again, sales in the state. So if you have customers in the state and you're performing services for those customers, that's a California sale. If you have sales outside of California, the sale for that service would be sourced to where the customer would receive the benefit of that service. If you're selling hardware into other jurisdictions, California's apportionment methodology is a little bit different when you're selling tangible property. So sales of tangible property, if you're a California taxpayer, would be to where you are actually shipping the product. So if you ship it, for example, to Colorado, I think that question came from someone who maybe had some customers in Colorado. If you become taxable in Colorado, that's a Colorado sale. California still has its throwback rule. So if you don't have nexus in that jurisdiction where you're shipping product to, that sale would then get thrown back into California, become a California sale. So again, you really have to look at all the different states and the way that state's apportionment methodology is. And even within the apportionment methodology, there's differences from state to state. So if you on the income tax side, if you are wondering, hey, I have customers all over the place or I have employees, we typically will do what's called a nexus study, similar to what Avalar is doing for sales tax. We do an income tax one to help you determine what filing obligations you have. But, typically what we've seen post-COVID is people working from home or people getting more comfortable hiring employees all over the country. And a lot of times what we see are tax returns where the preparer is preparing and filing a federal tax return in the state where the company is, but ignoring the other states where you potentially have nexus, and that could result in some exposure in those other states.
Yeah, that's one we see a lot where, hey, well, I'm just in California. No, but you have employees in Wisconsin and Oklahoma or whatever it is. And that actually opens you up because now you have that physical presence with some sort of employee. Because some of these questions are, around the sales tax and the income tax are, hey, I have a client that's based in Colorado, but they have a physical location in Washington that we're doing work for. So, it's that type of where is the physical business and where's the work being done. And this is why having a great CPA who can navigate through this is so important, because we're not just talking about liability of income tax or filing that you owe, but then penalties, interest, accrue, and sometimes those aren't always reasonable. Sometimes it's just a flat fee for the penalty, regardless of how large or small it is. So obviously,
Yeah, and if you have and if you have an individual income tax filing, so oftentimes, our MSP clients are S corporations and K1s flow up to those individuals. Many of these states also have state K1s that might go to the individual, right? And so that individual, the owner of the MSP, could potentially have to file in multiple states as well. So when you don't file tax returns in a jurisdiction, the statute of limitations never tolls. So as that K1 flows up to the individual, what you could run into is, I'm in California, so California has a 4-year statute of limitations, right? If you have a filing obligation in another state, they may come after you for 6 years of tax returns, but you may only be able to get the other state tax credit for 4 years. So for 2 years, you might actually end up with potentially being double taxed.
Got it. Yeah, it's obviously no one wants to be double taxed in that too. So
no one wants to be taxed. So
this next question kind of goes the line of both accounting and tax. We hear this a lot. This one comes directly from Adam in Las Vegas, an MSP owner out there. Should I account for revenue on a cash or accrual basis? And is it the same for tax filing? What's the pros and cons of a cash versus accrual for tax as opposed to running my day-to-day books?
Yeah. So we always recommend to keep your accounting records or your book financial statements on the accrual basis. It helps you run your business better. But just because you're on the accrual basis for financial statement purposes, you don't need to be on the accrual basis for tax return purposes in most instances, right? So, oftentimes it's better to be on the cash basis, especially if you're performing services or selling product. If you're getting cash in advance or significant monies in advance, so you might have like a 12-month model where people are paying you large sums up front. In those instances, it might be worthwhile looking at the accrual method of accounting for tax, because you potentially could defer the advance payments into the next tax year.
Got it. And doesn't that impact your quarterly estimates too? If, let's say, you were on cash, but you're receiving large lump sums at the beginning of the year, doesn't that make your first quarterly or your quarterly filings impacted after that?
Absolutely. So if you're receiving large sums of money in the beginning of the year versus the end of the year, you may end up with, moving some of your quarterly estimated tax payments into an earlier period. So,
somebody put in my Slack channel, refresh your cash versus accrual, simple terms.
So cash is simply it's the easiest method of accounting, where you're simply just including into income the cash that you receive and deducting expenses when you actually make payments, right? So accrual-based accounting, you're sending an invoice, whether you have received the cash or not, it's taxable income. And expenses, oftentimes, for tax purposes, there's special rules on accrual accounting, but for book purposes, if you incur an expense and you just haven't paid it yet, you would book a payable or an accrued expense and take the deduction.
Got it. So simple way. That's a question that I feel like it's just always it's the mystique of accounting and finance, cash versus accrual, and it doesn't have to be that complicated. I'll say the personal checking, you typically are going to run on a cash basis, but if you build your budget over the year, you're going to look at accruals. For instance, I pay my insurance twice a year, but that's obviously over a monthly cost. If you look at your cash, it's on a quarterly basis. So it's usually just think of that simple option. So appreciate that. And remember, no dumb
Yeah.
questions in this around finance and accounting. Um, this one goes really specific, and this is for an MSP. How do I properly separate my cost of goods sold from operating expenses to understand if my growth is profitable, or essentially the pricing conversation around COGS, and how do you properly allocate COGS versus op expenses as it relates to revenue? And this is from Hassan in Jersey City, New Jersey. Yeah, I have
All
that.
right. Yeah. So for purposes of allocating cost of goods sold, typically there's really a couple big categories that you really would focus on. One would be labor, right? So if someone spends 80% of their time manufacturing product, for example, or providing services, you would allocate 80% of that person's salary to COGS and the other 20 likely to either sales and marketing or G&A expense. Oftentimes your techs are 100% COGS. And so it's easy to take that person's salary and payroll taxes and benefits and all of that and allocate that to cost of goods sold. It's when you have people that are typically in G&A roles that spend a very small amount of time, doing services. Oftentimes these are the owners, right? Where people don't think about allocating some portion of their salaries and benefits and payroll taxes up to COGS. So, and then depending upon how granular you want to get, you might allocate rent, part of your rent to COGS or part of your utilities and all that. But typically we don't see a lot of customers or clients getting into that granular level of allocations.
Yeah. Yeah. And I think sometimes there's a lot of, ambiguity or misunderstanding around COGS, especially for an MSP being a service business where they think of, well, I don't have any COGS or I don't have direct hard materials except for the product or resale, but your labor is the cost of goods sold when you look at a financial performance perspective, because this question too was posed from the financial performance side of, hey, if I'm looking to see if a service is profitable, the next question or one of the questions we should get is, how do I price my service? Well, understand what do I need to make from a gross margin. If your all-in seat cost and you're pricing on a per seat miles and MSP, let's say your all-in seat cost is $30 to $40 of physical tool and subscription cost. You should also factor in, okay, roughly how much do we spend per tech per hour, per seat per month? If it's, a quarter of an hour or whatever, you add that in so you get a clear idea. Oh, my true cost of goods sold on my monthly managed seat, my basic minimum, all you can eat, is $65, $85. So I should price it probably at least 150 to 200 a seat. And if I can command a premium higher, that's going to cushion gross margin, which ideally those dollars should trickle down towards your net profit once your costs are covered from across the board. But most MSPs, we do see, it's the payroll is not allocated correctly. So it's really hard to say, oh, why is my gross margin 60 to 80% on my services, but my net profit's 10? That doesn't make sense. Or why am I negative and not seeing positive cash flow? Well, typically there's money being squandered away in the labor field, typically, more often than not. This goes into we do have another question. I'm sorry, I don't actually have who this was from. But what are the biggest tax write-offs or deductions unique to IT and MSP businesses, or some of the things that our industry is just missing for deductions?
Yeah, so some of the big deductions, obviously the big deduction is payroll, right? That's going to be your biggest deduction. But I think oftentimes, at least during the interim periods or, during the year, people don't really think about, tax, the actual state tax deductions that could potentially be had. Depreciation is another one. So if you're purchasing large amounts of assets, for your business, but bonus appreciation in Section 179. There's obvious differences there, but Section 179 is typically what we try and take because we don't want to be generating losses for our clients. So we would take 179 to manage taxable income. The qualified business income deduction is another one that will flow out to the individual. Many states have pass-through entity tax deductions also will flow out to the individual. So when we do MSP tax returns, we're really also thinking about the individual that owns that, because again, most of our MSP clients are S corporations. So we're not really just focused on tax deductions for the MSP. We're focused on trying to generate tax deductions for the MSP owner.
Yeah. I think that's a big part of it too, is looking at your tax structure of your business and your personal situation, and then building your plan out from there instead of saying, what can I do? Or making it, oh, we're focusing on mileage, or we're focusing on this, like really understanding, hey, are we set up for the best structure for our goals too? So that's a big portion of it.
Another one is retirement planning, right? So if you have an MSP that's generating a significant amount of cash flow, and the owner of that MSP is interested in generating or contributing to his or her retirement, those are also big deductions that could be had at the S corp. So,
got it. Yeah, and I know we're going to get into some creative things here. I know we've had prior Stride Lives, for instance, talking about the Augusta rule, turning your vacations into work expenses and work trips. And, we've done a lot of that creative side, but I want to make sure we get to these other questions today too. This is one that we get, and this was from multiple people, but really, what are some of the important factors for structuring my financials and my financial data today if I want to sell my MSP in 3 to 5 years? And then kind of secondary to that, it starts with the financials, but then what is the best tax advantage situation if I want to sell my MSP 3 to 5 years? What should I be looking at? For instance, adjusted ownership compensation. Hey, I take out this amount of money, but my MSP is that much profitable. So we'll start at the top with that question, because this was one that's very detailed in this market. But really, what are some of the things they should be doing to structure their financials to sell their MSP in 3 to 5 years?
yeah, I would say the biggest one is getting a handle on your margin. So we talked about cost of goods sold, but making sure that your income statement shows the revenue and then the associated cost of sales with that revenue. So if you have, recurring services, you have then the labor associated with those recurring services. If you're selling product or hardware or software, make sure that you have cost of sales related to those so that you can actually see the gross margin by revenue stream. That's probably one of the biggest things, right? So, and again, we see a lot of clients running through personal expenses through the P&L, getting all that stuff cleaned up. I mean, it's best business practice to never use your business for your personal expenses. So if you are doing that, you might as well just take distributions out of your business if you aren't already, and pay those personal expenses on your own. Buyers don't want to see that stuff. It sort of muddies the water.
Yeah, and I think it's not even just about the financial data. I remember Greg Northrup, shout out from IT Valuations. He told me this. He's like, it's also a confidence thing. It's the psychology of the deal of, if you're doing that, it's already viewed as I hate to say it, but unprofessional to be mixing your business and personal, and revenue. Not only from a practical, hey, if you're taking certain things and paying personally out of the business, it's probably more tax advantageous just to take it as distribution and then pay it personally from there, as opposed to not being able to realize the full deduction. But yeah, that's one where, your revenue line and your service line really starts that conversation for valuation. But then it's going into, okay, what's the quality of this revenue? What's the profitability of this revenue? Are you growing that revenue? And then looking at all of the expenses that go through the business, because when a buyer's looking at it, they're evaluating, okay, where can I reduce my cost and my investment spend because I have entities that I'm already spending this in and I can bring it a part of? Where are we duplication of efforts or labor? So they don't want to see a bunch of, hey, we owe my hotels and my credit card points and, oh yeah, my electric bill and all that stuff that we see more frequently than we would like to see.
Yeah. One word of caution on taking distributions to pay your expenses is that you really should have a good handle on what your tax basis is in your S corporation. If you take a distribution from your S corporation and you don't have sufficient basis to take that S corp distribution, you will be triggering a capital gain unknowingly, probably. So if you don't know what your basis in your S corporation is, you probably should pay attention to that before you take out significant distributions.
Yep. I think the basis conversation too, I think a lot of business owners think of that as a set it and forget it, but it's something that does need to be updated and maintained every year. And it tracks back to the formation of the business to get an accurate picture. So that's why balance sheet and reviewing your balance sheet and really your capital accounts is so critical, because we see it all the time where it's like, well, we have to go back 15, 20 years and recalculate basis. So obviously
Mm-hmm.
don't make your accountant's life more difficult. So
Yeah, yeah. When you see clients taking on debt and then taking distributions, more likely than not, you're going to have a taxable event somewhere.
now that kind of goes to another question, because I think there is some ambiguity around basis and, hey, I'm an S corp. I want to take I want to take my distributions because that's at 20%. It's at the capital gains rate. It's much more advantageous. How do they balance that without, taking too much out of their basis, and also reasonable comp from a W-2 perspective? How do you know if you're paying yourself enough as an MSP, and then also not shooting yourself in the foot metaphorically on your basis by taking out too much of distributions?
Yeah. So what we do with our clients is we have a pretty good handle on our clients' tax basis and their S corporations. We then start getting at what are your goals? Are your goals to fund retirement, or your goals to take out as much cash as possible? What are your goals with this business? But typically, with respect to reasonable compensation, we'll send a link to our clients where they can actually fill out a questionnaire that helps them or helps us determine what that reasonable amount of compensation is. If your goal is to not pay payroll taxes, then obviously you want to try and pay yourself as little as possible. If your goal is to maximize your retirement, you may want to pay yourself more. So it's a juggling act, and it really is. What are your goals? Are your goals to fund retirement? We want to pay yourself more. You might pay a little bit more in payroll tax, and you might actually lose your ability to take some of your qualified business income deduction, or in various states, the pass or entity tax credit. But you would reach the goal of funding more into your retirement account. So it's computational. Like, what are your goals, and what are you comfortable with?
Yeah, I think this goes into the next question which we had, which is the cash benefit, defined benefit combo, really maximizing that W-2, but then also taking deductions and the investments. I know on the 401k side, this is what we talk about, the benefit between a standard solo 401k versus truly a defined benefit plan and a corporate 401k. But can you kind of go into some of the advantages of why an MSP owner, or why they would want to set up and focus on retirement instead of just taking that all out as distributions from the business and then putting it into a brokerage or something like that?
Yeah. So the key, or what we try and do with retirement plans, is take a deduction at the business, right? So the employee can fund his or her employee contribution, which is that $23,500 limit. Beyond that, the business could potentially fund the rest of your retirement for you, and take a deduction. So again, most business clients are S corporations. That deduction then flows up to the individual as well, right? So if your business is funding retirement, then the business will get a deduction for that.
See, I think that's a huge option. Plus, you're also looking at the eighth wonder of the world, compound interest. So
Yeah,
if you're putting
yeah,
that
exactly.
money in, $100,000 today could be $400,000 come retirement. So I like to think of it that way. It's just like when you look at paying off your mortgage early. Hey, you're spending every cent you spend extra on paying your mortgage early is technically spending 4 cents of purchasing power in the futures for what you would have paid. So I think that's
Yeah.
why it's such a huge proponent is we say, hey, don't look for fancy deductions. Go with this. Are you doing things basic? Like, are you saving for extra cash flow for retirement? Do you have a 401k for the business? I think another one is the whole how S corps are really into health insurance, the HSA funding, and how to get family members involved. Some of the creative strategies there for, hey, if I'm able to build and put my kids on payroll and doing that stuff. What guidance or answers do you have around that to say, hey, this is where you should focus if you're looking at incorporating the family and maximizing any health insurance savings within from a tax perspective for your business?
Yeah. So when you're thinking about putting your family to work in your business, I think the key thing to think about is what is their role and what is the amount of compensation you're going to give them, right? If you have a 2-year-old and you bring him into the business or her into the business and pay him $200,000, that's probably not going to fly. I'm not sure what a 2-year-old could actually do in your MSP, but when you bring a family member into your business, they have to be doing something for the amount of compensation you're paying them, and the amount of compensation you're paying them has to be commensurate with the service that they're providing. So that's key. If you're bringing your kid in to work for you and he's just going to sit in a chair and earn $100,000, that's probably a little bit aggressive.
Got it. Well, thank you. I appreciate that because I know we see a lot of that of, hey, I could just put it on. You hear the Instagram tax strategy or the Facebook tax strategists out there saying, hey, you can
Yeah.
do this. You should do this right
Yeah.
here.
The other thing we see is people bringing their spouses on board, right? And again, your spouse is going to be subject to the Social Security tax, right? The Social Security and Medicare, the FICA tax. So, if they don't need to be on payroll, you could pay yourself that salary. And if you're exceeding the Social Security and Medicare cap or the Social Security cap, then you might be saving yourself a little bit of tax.
Absolutely. Well, let me check the logs here. I don't have any more questions in Slack right now. I have some MSP specific metrics, but I really appreciate staying on the tax side, accounting, financial management. I'm going to kind of end it because we're close to time here. But what I'm going to say is, Morgan, I'll ask one last question. What are some of the most important questions that an MSP owner should be asking their CPA this time of year?
I think this time of the year, you probably should be trying to get with your CPAs to start talking about tax planning for 2026, right? So many of the One Big Beautiful Bill Act items are taking effect in 2026. How does that change your tax situation? If it's helping you reduce your tax situation, maybe you want to think about reducing your payroll tax or your withholding tax on your W-2 to try and increase your monthly cash flow from your salaries. Just get with your CPA. The sooner the better.
Absolutely. Don't wait till the last part of the year. Don't be that guy in December with a couple weeks left say, what can I do to improve my taxes for next year? It's probably
Yeah,
too late at that point. Start now, start in August, start in July, start as early as you can. So,
yeah.
Morgan, I
I mean, a lot.
appreciate you. Thank you for doing this. We'll probably do this again. We'd like to have this and get a little bit more attendance, get some more live questions. So, if you guys want to submit any more, feel free to submit more to email or you can put them directly on the episode and we'll check on LinkedIn. So, Morgan, thank you.
You bet. Have a good one. Bye, everyone.